You can build a small team and you can get 50, 100, maybe up to 200 units kind of by yourself. And you can crush it doing that. I mean, you can make hundreds of thousands of dollars a year. I didn't choose that path, but that's an awesome path. But to me, the other path is buying bigger properties, which you're not going to be able to do yourself. So you're going to bring in investors, and then you can't do it all. So like you're going to start building a team. And that to me, Axel, is like building a business. And I was really interested in building a business. So that was my mindset pretty early on.
What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. In this episode, I'm chatting with Lee Yoder, who is a repeat guest on the show. And I wanted to bring him back because he's a multifamily operator, right? And I love chatting with guys who are out there growing a multifamily portfolio who are also operating their assets. And I think right now, these types of conversations are really interesting to the folks who listen to this show that are active multifamily investors, because we're all trying to maximize NOI. We're all trying to do our best right now to effectively operate our properties as the market continues to be challenging for multifamily operators. And Lee's got all kinds of experience with this, and we spent a lot of time in this episode talking about how they transitioned out of working with third-party management to bringing management in-house, some of the challenges as it relates to doing so, some of the things that he thought would be easy that ended up being pretty hard, and also the advantages of having management in-house as well, and some of the disadvantages. That's another thing we talk about as well, is there are some disadvantages to having management in-house. And Lee's got a great story. He's got a bootstrapped a portfolio from a duplex to 800 plus units acquired. They now syndicate large multifamily deals, but he's someone who did some smaller deals, then started scaling the business, then took their management in-house, and they've been growing that in tandem, and they've been buying deals at the same time, and they've gone full cycle on a couple of deals, and they've taken some lumps. And he's just a great guy, genuine person who is willing to share some of the challenges that they've had as they've grown their portfolio. And he's got a great story, and he's an entertaining dude. So I think that this is going to be a really fun listen for all of the active multifamily investors out there. And if you're a passive investor as well, if you're an LP, I think that these episodes are also valuable to listen to so that you can better understand what's going on behind the scenes from a sponsor standpoint when you're evaluating a deal, a sponsor, etc. So hope you enjoy this episode. And if you do enjoy it, please leave the podcast a rating and review. But without further ado, let's get to this episode with Lee Yoder. I'm joined by Lee Yoder, Threefold Real Estate Investing. Lee is a repeat guest. So if you guys are looking at the name Lee Yoder and you're thinking, where have I seen that? Maybe it's LinkedIn, maybe it's elsewhere, or it could be from the Multifamily Wealth Podcast, all the way back, episode 171. So 2 years ago, as we were just talking about here, Lee, before I hit record. So it's been a little bit, and I know a lot's changed in your world, and I'm excited to get into it here. But before we do, why don't you share just kind of a refresh on your backstory, what you were doing pre-real estate, how you found the real estate business, and what you guys are up to today.
Sure, Axel. Yeah, thanks for having me back, man. Great to connect with you again. Yeah, so going all the way back to 2012, I graduated with my doctorate in physical therapy. So I became a physical therapist. Did that for a bit, got on with a company here in Cincinnati, Ohio, where I live. This was a staffing company. I came on as a physical therapist, but I pretty quickly, after like a year, became the clinical director. So I was managing with a bunch of therapists out in the field. But this was like a startup company. And so really what I was enjoying a ton was building out a division for this company. And so it was a very entrepreneurial feel with what I was doing with this company. I was answering to the founder, the president. He was really giving me a ton of freedom to build out this division, and I was loving it. And I was doing no physical therapy at the time. So this is, 3 years in, maybe 2 to 3 years into my career as a physical therapist, and I'm actually doing no physical therapy. I'm managing therapists, but again, really what I was enjoying was building out this division. So did that for a couple years, and then felt like this company wasn't a long-term fit. But by this time, Axel, I'm like, man, I cannot just go back to being a physical therapist, because I found what I enjoyed. Like when I was a physical therapist, it was not fulfilling for me. And I was doing outpatient, then I was doing home health. And home health, you drive around to older folks' homes and sit there and do physical therapy with them, maybe go for a walk. And it's a very relaxing job, but that's not really what I'm looking for out of a job. I want something kind of more intense, something challenging, fulfilling. I just really enjoy work, and I want to do something, challenging and exciting. And home health physical therapy wasn't that for me. Now, it was great for my family because it was pretty laid back. I wasn't bringing work home with me. It didn't stress me out. And I didn't honestly worked 40 hours or less each week and very flexible. So then when I was with this company, kind of climbing the corporate ladder, building this division for a startup, it's kind of the opposite of that. It was very exciting, very challenging, but it was kind of consuming as well. And it took, significantly more than 40 hours a week sometimes. So my wife and I were starting our family. And so that's when we were feeling like, man, I don't know if this is the job that God called me to and kind of the life that my wife and I were looking for. So that was where I was at, Axel, where I'm like, man, what am I going to do then? So start reading books, start talking to people, start learning a little bit about real estate, about entrepreneurship, thinking like, man, maybe this is what I'm looking for. A buddy of mine at church was full-time in real estate, owned some rentals in Cincinnati. Started talking to him and started feeling like, I think this is it. I think I want to get into this. My dad's in construction, so I grew up around construction. Just a lot of things were kind of lining up that I thought maybe real estate was it for me. So I did go back to being a home health physical therapist with the idea that I was going to start a real estate side hustle. So this was in 2016 that I left that corporate job. 2017, we flipped a house. 2018, we did a duplex. 2019, we did a few small multifamilies, 34 units in total. 2020, we sold that whole portfolio. My wife quit her job to stay home with the kids and homeschool. I quit my job to go full-time into real estate. So 2021, we started syndicating, which just means bringing in more investors, buying bigger properties. And we've been doing that ever since. And I think you read that in the bio or something, but we were about 900 units. We've sold a few this year, so we're down to 750. We manage those ourselves. We started a property management company 2.5 years ago, which goes all the way back. Man, I was talking to you, Axel, years ago, and you guys were doing it. And a couple of things you said really stuck out to me and helped lead me in that direction. So anyway, that's where we're at today. And that's the story behind it all.
I love it, man. I appreciate the context. And I think we're just going to start. I want to kind of start early. I want to go back probably to that 2018, 19, 2020 timeframe. So you mentioned flip a couple houses, buy a duplex. And then it seemed like there was 1 year to the next from doing that to 34 units, if I'm remembering that unit count correctly. And that's a pretty big jump. That's a pretty, that's fast growth. I think a lot of the folks who get into real estate, right, they maybe buy a duplex and they buy a 4-unit. Maybe they buy a couple of 4 units, and there's a little bit more of a linear approach.
Yeah.
Was that deal just something that kind of came out of the blue, or was there like a conscious thought process on your end, basically where you're telling yourself like, hey, I want to go out there and do something much bigger for the next deal. I want to try to shortcut this. I want to try to grow a little bit more rapidly. Or is this something that, hey, we got a 34 unit deal through this really interesting connection. I'm just going to go and figure it out. Talk about how that came to be and maybe some of the challenges you had with that.
Yeah, some of it was finding a deal, but it was a conscious effort. I mean, the whole time I'm trying to get into real estate, the whole time I'm flipping the house, doing all the work, listening to podcasts like yours, Axel. I'm like, the guys and girls I identified with and what made sense to me was going bigger, was buying bigger multifamily, scaling. I was just really into scaling. And as I got into it, Axel, and I even kind of almost job shadowed some guys here in town where I live north of Cincinnati. And I really developed this idea that when you get into real estate, especially when you get into multifamily and kind of small multis, you can go one of two ways. You can build a small portfolio and kind of do it by yourself, be a solopreneur. Maybe it's you and one other person, but you're kind of a solopreneur. You can build a small team and you can get 50, 100, maybe up to 200 units kind of by yourself, and you can crush it doing that. You can make hundreds of thousands of dollars a year. Eventually, right? Like you got to pay some of them off. You got to refinance, you got to let it have time. But 10 years from now, you could have 100 units by yourself and never have to work again. So I say all that because I didn't choose that path, but that's an awesome path. But to me, the other path is buying bigger properties, which you're not going to be able to do yourself. So you're going to bring in investors, and then you're eventually going to have so many you can't do it all. So you're going to start building a team. And that to me, Axel, is like building a business. And I was really interested in building a business. So that was my mindset pretty early on. And, the duplex was just a great proof of concept for me. We really kind of gutted it, turned it over. And we were probably making about $200 per unit per month, which is great for a duplex because this was a different time and we bought it pretty well. And so, $400 a month, right? $4,800 a year. And I'm like, man, if I did 10 of these, I'm making 48 grand a year. That's not going to be enough for me to go do this full time. I do 20 of these, 96 grand a year. Yeah, I could go do this full time and then keep going. But I didn't want to own 20 duplexes. So it was kind of like, man, I want to do this, but I want to do it at scale. I want to build a business. And so that was the idea behind it.
Yeah, and I think it takes people a little bit to realize that. Like, I think a lot of the folks who get into real estate, at least the folks who come into this from a different career or they
Yeah.
started organically. I mean, there's the subset of folks who do what we do, where they come from a larger real estate shop, right? And they're like,
Yeah,
okay,
sure.
works professionally in real estate, maybe for another
Yep.
company. But for the
Yep.
people that kind of bootstrap it and get into it
Yep.
in a different way, you oftentimes buy a deal or two, and then you're starting to sit down and do the math, and you're like, this is going to take a while if I want to get
Yeah.
to the 50, 75, 100 units or whatever that's going to replace my W-2 or my business income if you're running a business or whatever. And you're like, all right, so I got to take a different approach. And then it's,
Yep.
okay, so let's take a step back. Okay, I probably have to take a more structured approach to building a business around this. It's probably going to take some partners, maybe some investors, maybe I have to do this, do that. And then you start to make decisions significantly differently because you have a
For
different lens
sure.
through which to look at it, right? And I think,
Yeah.
yeah, you just got there a lot faster. It took me a while to get there. I remember I was like 30, 40 units myself, and I'm like, all right, this is, I'm still not, I still have to keep replacing the roofs on everything I buy and a heating system there and, whatever
Yeah,
there. And it's just hard to really scale from a capital standpoint.
for
So
sure.
speaking to capital, let's talk about
Yeah.
21, we quit the job, we start syndicating deals. Maybe like initial challenges, right? Obviously, we got to go and bring investors in order to
Yeah.
fund what we're buying, right? That's fundamentally what we're doing when we're syndicating deals. First $1 million, couple $1 million, when you're raising that money, kind of who's it coming from? Maybe some of the early challenges that you had with actually getting investors across the finish line. And how did you start to address those early when you started raising capital? Maybe there was some tactics you employed as like, I started growing my list by doing this, or we started structuring our deals in
Yeah.
this way to get them involved. And, what were some of the early challenges there?
Yeah, it was definitely challenging. I mean, I'll tell people all the time, like basically every capital raise I've ever done has been really hard. We've not found the easy button yet. We're not raising more than we need by any means. I mean, it's been tough and it's just been organic for the most part, man. I mean, I've done a lot of things and I haven't done a lot of things. I've honestly not spent that much money, Axel, to be honest with you, like on marketing or, I did a podcast for 3 years. I didn't spend any money on it. So I haven't done a lot of things, but I mean, we've done some things. And honestly, none of them have really done that much beyond just like talking to people,
Hmm.
talking to people, those people talking to people, and just establishing a track record and people kind of seeing it, and it just takes time. So that 34 units, that was actually three separate deals, but we did them like a month apart. They just kind of came in rapid succession in 2019. We did a 16 unit, 8 unit, 10 unit. And so we had like one or two investors on each of those. Those were just joint ventures, just kind
Yeah.
of simple. So we sold all those. So those three different people, they had some money because we did really well because we got the COVID stimulus boom to help us out. So they did well. So they put back in, but then a friend from church, my partner at the time, his aunt. So like it starts with family and friends. And then the other thing that maybe a little honey pot that helped us raise some capital, Axel, was the local RIA. So my first mentor was at the Real Estate Investors Association in Cincinnati. I became a part of that. The guy that was leading the apartment focus group there, he really helped me and held my hand through getting that 16 unit, gave him a piece of the deal. He helped me a lot. I didn't partner with him on the next two. He's like, Lee, you're just going to need me on the first one, then you're going to be fine. And he was kind of right. But then the second syndication we did, the first one we only had to raise $550,000. That was a lot of the repeat investors from the first three. The next one we had to raise 1.3 million. So huge step up. We actually brought him back in on that one with us. And he ended up bringing quite a few investors from the Real Estate Investors Association into that deal. So that kind of grew our list pretty well. And then again, like you bring in some of those people and they start talking to the other people in the group. So that definitely was kind of an early boost to our capital raising efforts. But mostly, man, it's really just been talking to more and more people, our investors talking to other people, and just kind of growing organically. I haven't really hit on too much else that's really helped us raise a lot more money or anything.
Yeah, well, you're describing like the playbook fundamentally, which is, and I love to think in like frameworks, and I think if I were to speak to somebody who was getting into this business who wanted to start raising money, it's 0 to $1 million, special circumstances aside where you've got a really wealthy uncle who's going to fund all
Yeah.
your stuff or whatever, you've got there's a lot of folks out there that should lean on those specific scenarios if they're applicable to your
Yeah.
situation. But generally speaking, for most of us out there who are surrounded by people that don't know we're in real estate and we're maybe starting from a place of like, I can raise a couple $100,000 from this person or that person, but that's really it. Like 0 to $1 million is just like outbound. It's like you got to go out there, you got to have those conversations, you got to go to the
Yeah.
meetups, you got to.
Yep.
It's just brute force. It's a ton of phone calls. the email list and going on podcasts and this, that, and the other, they're not really going to help you that early because you have nothing to, you can't build trust with anyone who's really cold in any way because you don't really
Right.
have a track record. You've done nothing.
That's right.
So it's like
No,
0 to 1,
exactly.
you got to do that. Like 1 to 5, okay, maybe you start to do some of that stuff where you send out a monthly newsletter and you got a website with a lead magnet. And then
Yep.
5 plus after that is all those people that went 0 to 5 with you. Ideally, you've sold a couple deals, and now they're reinvesting, and now you get the
That
referrals and
too.
all
Yep.
that. But it's like there's no real secret sauce as you've described.
No.
And I think JVing early, I think is probably really helpful, right? Where it's like, I'm not going to go out there and try to find the doctor who's got the 250K who's like, I'm okay with being purely passive. Like a lot of those early deals, if you're the guy finding the deals and operating them, if you find a good deal, you're probably gonna have to take it to another active real estate guy who like can make a faster decision and kind of knows what he's looking at in that market, he or she or whoever, and can get a little bit more aggressive and maybe write a bigger check, but you're probably gonna have to give up a little bit more of the deal, and that's just
Yeah.
how it goes early on,
Yeah.
right? Now, you mentioned like a lot of that stuff was kind of what you did early on, and I know you hosted a podcast for a while. I know you're active on social. Like, let's fast forward to 2025. We're going to be heading into 26 pretty soon after this airs. Like, any kind of big frameworks in your business as it relates to like we kind of do these different things to bring investors into our business, or is it still very much like word of mouth, referrals? I'm going to the active meetups, I'm getting in person, or is there anything that you kind of do on a recurring basis that you think about as like this is my lead gen for investor stuff?
Yeah, man, all I could say going on podcasts has definitely been helpful. I have gained investors from going on podcasts, so I try to do that pretty regularly. Posting on LinkedIn has brought some investors in, just putting yourself out there, kind of being consistent with it. People getting to peek into what you're doing, and then at some point deciding, okay, I've been watching this guy long enough, I'm interested. We do the monthly newsletter. So I think, yeah, people hear about you a time, see some stuff on LinkedIn. Okay, maybe I'd like to opt in. So they come in, keep watching, but now they're getting the monthly newsletter. So now they feel like they're inside our circle and they're seeing it. They have to talk. We only do 506B syndication. So you have to have a relationship with, because we take non-accredited investors. So eventually you have to have a call with me if they're going to see our deals, but they might do that. And so it just, yeah, trying to pull them in little by little. They get more and more familiar, more and more comfortable, and eventually they decide to take the plunge. The only other thing I'll add to that, actually, that we've been doing past 3 or 4 years, is that at least once a year we get a pretty decent sized group of our kind of most seasoned loyal investors together, and then there will be some other guys and girls that I target that have been interested. And it's like some of our bigger investors. So one thing I've been leaning into a little bit is if somebody invests $500,000 with us, that helps us a lot. That gets us to our number a lot quicker. And so we have had some of that. And so those are some of the people I'll invite to this dinner. So we did a bourbon tasting. One of my brother-in-laws is really into that. So he and a guy did a bourbon tasting for a group of our investors. So that's been kind of neat to like, and it's with a lot of the investors that are really already bought in, but man, it gets them even more bought in. And then we invite some other people, and then it's that group of people that are your advocates. I mean, some of these people have told others and brought in some other big investors. So that's the only other thing I'll add that we've done. But mostly it's, yeah, just trying to kind of build out that list and let people slowly get familiar with us.
Yeah, I mean, I think that's huge, right? Because I think fundamentally what people should take from what you've just described is that there's no special sauce, right? I think
Yeah.
I think I ask that question, and every once in a while there's like, oh, we do this, very interesting thing, but like it's usually really just a version of what everyone's already doing, which is like go on podcasts, post on LinkedIn, try to generate the top of the funnel, get people kind of
Yep.
vaguely interested in what you do. They get on your email list, you build trust with them, eventually they invest. And it's like that's fundamentally really the game, especially at this point in time. I say this point in time, meaning like where we're at right now, capital
Yeah.
wise. It's harder to
Yeah.
raise money right now than it was back in 21, 22, back when money was really flying around and you could probably do some more of those unique things to try to drive
Yeah,
traffic to your
probably.
business. But now it's like so driven by trust and experience.
Mhm.
And when I say experience, one experience as an operator when you're raising money, but experience that an investor has with you previously that like really starts to drive a lot of this stuff. Let's talk about operations here because I think this is going to be really interesting. You guys brought property management in house. I don't remember when you did that. That was a couple years ago, right? That was probably right around the last time we chatted, like 23
Yeah, just
timeframe.
before, it was like May of 23, so about 2.5 years ago.
Okay, so let's talk about portfolio size before that, maybe the driving reason you wanted to bring it in house. And
Yep.
then I'm gonna, and without throwing too much at you, I kind of want to hear obviously everyone knows there's challenges with bringing stuff in house, right? Now you have to go you got to hire the leasing person, the property manager, the maintenance guys, and there's friction and challenges with that. I want to hear about like maybe some of the stuff that you went through or dealt with that like wasn't something that you expected to deal with when you brought it in house, like some of those little kind of items where you're like, oh shit, I never thought that I'd have to deal with this or whatever. Some, because I know that, as we did that, we had so many of those different little stories. So I'm interested in those, but let's talk about kind of portfolio size, why you did it, and then we'll get into that.
Yeah, we were at like, I want to say like 283 units, I think, total. And maybe that was with this purchase. So we were making a purchase in May of 2023. It was a 48 unit and a 16 unit in Northwest Dayton. And the property management company we were using, they're out of Cincinnati. They managed at the time like 10,000 units. They just didn't really want to manage it. They're like, yeah, it's kind of small. It's a little bit further out there. We're going to be pretty expensive on that. And I'm like, man, you guys are already expensive because they were managing all of our stuff.
Yeah.
I'm like, you're already expensive. If you're saying you're going to be expensive, I can't imagine. And the property actually came with an guy that lived on site and was managing the property, and it was the seller's brother. Now, when I heard that, I was like, we're definitely not keeping that guy. But the more we dug in the property, Axel, like the more I was like, this guy's actually doing a great job. Like you can tell a lot when you do an inspection, when you talk to the residents. And it was just clear this guy was doing a really good job. He'd been there for like 8, 10 years. And so we thought, man, maybe this is the property to try it with. Why don't we just try it with this property? We'll bring one property in house. So our other stuff, we continue to let that property management company manage for us, but we brought this one in house. And it really went pretty well. And so we were making another purchase that fall, like October, and it was 96 units. And the property manager and the maintenance tech that were working for the previous owner wanted to stay on. So we're like, okay, I think we can do this one too. Because by this time we were using Appfolio. We had our software, had some things built out. We knew how to pay somebody. And so we brought that one in and went pretty well. And so then eventually we actually sold 2 of the properties that we owned that summer. And then we only had 2 left, the 96 unit, 95 unit that the property management company was managing for us. And so we ended up bringing those in house. So that's kind of how that transition worked. And the biggest thing that was a surprise to Axel is just all that goes into having employees.
Yeah.
I mean, what I eventually, I got into multifamily in 19. We really got into it in a bigger way in 2021. So by 2023, yeah, gosh, I thought it was longer than that. I guess so. It had been 2 years, and I just felt like we had learned enough. And I got to the point because most of our properties are big enough where we have somebody on site, a property manager on site, and a maintenance guy on site. And so I'm like, man, yes, we have to manage those people, but like they're the ones doing the work. So if we employ them instead of the property management company, it doesn't seem like it'll be that hard because we just need those people to keep doing the work just under our name instead of their name. And I wasn't too far off in thinking that, but just all that goes into having them as our employees is a lot. I just can't get over how many, I don't know, how much bureaucracy there is, I guess, behind people and the taxes and unemployment and workers' comp. And I mean, we have one employee in Kentucky, and we have to do all this stuff for Kentucky just for one employee that's down there. I just feel like I get stuff all the time. And then, I get something in the mail. Well, you didn't pay tax in this city because this employee, they're in that city. And I mean, we use Gusto and it handles a lot of stuff for us. I'm actually very happy with that system to handle our payroll, but there's things it misses. And so then we let a guy go and he files for unemployment. A lot of the guys we hire owe child support. We get letters about that all the time about taking money out. So I eventually hired an executive assistant for multiple reasons, but the main thing she's turned into is like HR and payroll because there's so much that goes into all that. So that's probably the thing. And I mean, people told me that. You probably told me that, Axel. Other people that probably told me that. And it's just something you got to see it for yourself to believe it because it's a lot. That's the thing that probably surprised me.
Yeah, and I think it's hard to really understand that until you're in it, right? And as you just shared like 3 or 4 things where it's like, why am I getting like this letter from this particular person about this and that, and like you miss a step in an onboarding and this is sideways, and maybe you accidentally you got 3 paychecks going out this month instead of 2, and then it changes your it's just like a whole bunch of random stuff that kind of accrues. I think is really the challenge that a lot of folks have, because I think oftentimes real estate guys, I mean, I'd probably throw both of us into this, right? We're like deal guys. You want to go out there, you want to find a good deal, you want to go and network with the brokers, maybe you like speaking with the investors. But a property management company is fundamentally tasks at scale, excuse me, and then HR, right? And people, it's all people. Yeah. So it's a bit of a different skill set. And I think always what I've told folks who are thinking about bringing it in-house, and this is what we did, and I look back in early 2020 when we brought it in-house as like thank goodness this was the structure, was that I had a great partner who I started the management company with, and we do third parties, so it's technically a different business. but
Yeah.
he's like, he owns the day to day. I'm behind the scenes from an advisor standpoint, and we have a very clear cut relationship. And that was great because it's like you can focus on the minutia of property management and what's required to excel within that business. And I can still go out there and hunt deals and look for deals and try to raise money and do all that.
Oh, for
And
sure.
and I think that's like a big thing for folks. It's like if you're going to bring it in house, you should hire somebody who has the experience, maybe overseeing that. There, but then the side or the byproduct of that is you typically have to wait longer because you have to be able to afford that person, right? In terms of
Yep.
your unit size.
Yeah.
I mean, you mentioned you had a couple hundred units at the time, and I think it was probably you were probably at a level of scale to where the property management fees that you were charging back started to make some sense. But was there a point in the growth in regards to like portfolio size where you really felt like, okay, I've hit this unit count number or this business size to where I've now put some people within this, side of the business that's starting to free me up. And, I guess I like to ask that question in terms of like, was there an inflection point where once you hit it, you were like, okay, it's getting a little bit easier now for me to kind of manage the properties that because we're doing it in house and then also go out there and chase new deals.
I'm hoping we're almost there, Axel. I don't think I'm there yet. So I kind of tried multiple times to have a partner like you do. And in one case, like he actually wasn't a great operator. He's more like me. So it's like, okay, this isn't the right match. And so he and I had actually parted ways, even though we still own some properties together and we're great friends. He's an awesome guy. But I was like, dude, neither of us are operators. We're not the right partners for each other. But he and I went separate ways before we even started the property management company. Then I brought another guy on and he wasn't my partner, but was kind of grooming him to run the property management company. And he was into that. And then he took a job as a pastor and moved to Jacksonville, Florida. So that one fell apart. So I've never had like that partner. I have a regional manager and she's not going to run my property management company. She's been awesome, like a great support. She goes to our properties a lot. So she does. There are people in place that do take a lot off me. She handles all the calls from our property managers. Her and I both are on our weekly meetings with all the property managers and, talking through everything. So I'm definitely still involved more than I want to be. Where the property management fees, we've got two different properties identified that would take us to 1,000 units. And with where we're at today, we were able to hire like an accountant, almost like controller. That's going to be a big hire. That's like part-time. I think we just offered the guy today. I'm excited to bring that in to help our back end accounting, finance department. That'll be big. And then with the next two, I'm really looking to hire like a director of operations / director of property management. I cannot wait to hire that person. Really want to get that one right. But then I think I'll really be able to be more in a position that you're in, Axel, like an advisor. Somebody that's like, hey, I kind of know what's supposed to be going on over here. I've been in it, done it, but I'm going to spend all my time over here. But I'm going to come to the meetings with you guys and things like that. So maybe 1,000 units will be where I really want to be because I really don't want to have much to do with property management. I mean, I love building a team. It is really fun to bring on good people and build the team, and it's part of the scale. And so I don't ever want to be like totally out of it, but I really don't enjoy the day in and day out, the weekly meetings and stuff like that. So I'm hoping 1,000 units, we're almost there.
We're close. Yeah. I think
Yeah.
it sounds like a couple more, decent sized deals, right? And you're crossing that threshold. It's funny because I own some buildings with just a partner of mine up in New Hampshire. And I think we own, I don't know, 200 units together now or something like that. But he manages them all in-house. Very similar structure that you're describing where he's very much involved in the PM. Organically, he's had it in-house since, deal one and has just tried to divvy up his time between I'm kind of managing these. Oh, now I can afford a leasing person. Now I can afford a maintenance person. Now I can afford a property manager. Very linear bootstrap growth over the years. And he's just like, I just got to get to that point, man, where it's like we get that, and I think in our market, that's 300-400 units. We're in a market where properties are a couple hundred grand a door. So it's a little bit, more expensive market. But,
For sure,
but he's
yeah.
like, once I make that higher, I'm going to overpay the hell out of this person. And that's going to be like where I start to really get, 10, 15, 20 hours of my week back. But he's like, part of that is I got to kind of own the buildings that we have. It makes it a little harder to sell some of them. And that's a piece that's a little bit more fluid as well as you're a little bit more anti-fragile in regards to maybe some of the, sales decisions, right? Because you want to kind of retain that base. So let me ask, right? Because you just recently sold a couple you mentioned during the intro there. Took you from maybe around 900 down into the sevens, I think vaguely is kind of what you described.
Yeah.
Why those buildings, is it just came time to sell them? We'd owned them for a number of years, or was there some further thought process behind, let's go sell these buildings for these reasons. And, I always like to learn about why people decide to sell.
Yeah. Yeah, really only so two were really small. They were part of a really big portfolio that we bought, and they were two outliers. So that's
Gotcha.
why we sold those. And it was a 12 unit and a 10 unit, just real outliers that were going to be really difficult to manage. So that's why we sold those. It was a 22 property portfolio. So
Wow.
just wild. And so we sold two of those. The other one, you hit the nail on the head, Axel. It was a real it if we were not managing it ourselves, it would have been a much easier decision. The fact that we were managing it, it really did hurt because one, we didn't love to let go of those two people. They were part of our team. And so that was kind of hard to do. But two is, our properties are under 100 grand a unit usually. And so, they rent for 900, 1,000 a unit or something. So on a 96 unit like that, like our revenue is somewhere around $1 million, maybe 1.1. So we just do kind of a standard 6% fee on ours, but that doesn't include the payroll. And we don't think we can get into that if you want. But the reason I say that is like that was like 60 grand a year in a property management fee that we let go by. So it's like, man, I'm trying to build up our fee base and I'm not getting any of that, but that's what allows me to hire these pieces. So when I'm trying to hire a director of property management, I just lost 60 grand that could, and of course we spend some of that money, but honestly, a lot of that is for our payroll, for our like internal staff. So at least maybe 50 of that 60 could go toward that director of property management or director of operations. So that kind of hurt. So to give you the reason behind it, Axel, I mean, to be honest with you, we were in kind of a tough spot with that property. Now, it was cash flowing fine. I mean, we had great debt on it. So honestly, it's like, why is it not cash flowing even better? But we really just kind of ran through our CapEx fund, our reserve fund. And so we still had like $100,000 plus in it or whatever, maybe 150, but it wasn't enough to keep paying for all the unit renovations. And when you get to that point, it's hard. We were still cash flowing, but you need a lot of cash flow to distribute to investors. And we didn't have that much cash flow when we're paying for their unit renovation. So it was like, man, do we refinance this? Well, it's not a great time to refinance. We would be getting a much higher interest rate on that one because we bought it at the end of 2021. So, we were coming up on our 4 years of ownership, and we told the investors this is a 5-year plan. So it wasn't like we were that far off on that. So we sold about a year early, but that's really what it came down to. Is like, man, we're going to keep kind of limping along, like not doing distributions because we don't have the reserve CapEx fund to pay for the unit renovation. So that's where all of our cash flow is going. And so that's okay. I mean, we're paying off debt. That was amortizing and things like that. And like I said, the property's fine. It's stable, but it was like, I think it's better to return capital and go ahead and take it. And I felt like, I don't know that this property is going to be worth more in a year. That was the other thing that you look at with a property. It's like, you wouldn't want to, there's something to be said for leaving some meat on the bone. You can typically sell better like that. But if you see a bunch of upside and you like the property, you're probably going to want to hang on to that for yourself. And that's just what we didn't see with this property. It's in a C-class area. It's not changing anytime soon. We felt like our rents were basically at market. Now, the next buyer disagrees with us. He thinks he can take it higher. Maybe he's right, but we just didn't see a lot of upside. So it's like, why would we wait for a year of no distributions and we're going to sell it for the same a year from now? Maybe let's sell it now. So that's why we ultimately decided to sell.
Yeah, it's a great. I appreciate you running through the thought process because I think
Yeah.
there's a lot of folks, especially right now, who are in a situation, and a piece of what you said, I think, describes a lot of or the situation that a lot of folks are in, right? Where I've owned this for a few years. We bought it when rates are low. We've created value, and now maybe we want to refi. Maybe now we want to do something here, but we're refinancing into a higher rate. And the transactional cost of refining into the higher rate, because now we're going to have a prepay on the new loan, or we got to pay the point to the broker to get into the new loan, or whatever it is. We're committing to holding on to it for now, another couple of years, right?
Yeah.
Or we could sell it and maybe turn it over, right? And I think that there's a lot of folks get into real estate and they want to hold forever. I mean, it's really hard to do that if you're syndicating deals because at some point you kind of have to cycle your deals. And I think this is just an observational thing that we've learned in our business. I'm sure it's similar in yours where a lot of the early deals you do where the investors you have in those early deals, you want them to see a win. You want to book a win for them. So they write you another check. So they tell their friend, hey, I invested in this deal 2-3 years ago, just sold, did really well. Maybe something that you want to check out. So you can start to grow the investor base. But the hard part about being vertically integrated is to satisfy the objective of show wins on the track record and continue to build relationships with those investors comes at the cost of maybe building the organizational back end from a management standpoint. What's the right answer? There's probably no right answer, right? I think it's you have to determine what is more important for you at a given time, and that's probably how you start to make that decision, right? So it's and I think a lot of what we talk about in our world, and that I have these conversations with a lot of other folks. It's like having management in house and doing a good job, having it in house and assuming that you do a good job at actually,
Yeah.
property managing your assets is a huge advantage. It allows you to do a whole lot of stuff
Mhm.
that other folks can't do if they're just using third party. But like there are these other considerations. It is a really challenging thing to do, and that's why a lot of people don't do it. It makes your business a little bit more anti-fragile. You got to worry about a whole new, line of or a whole new vertical within the business itself, and I think there's a lot of considerations there. But regardless, let's talk about, maybe how the acquisition criteria has changed. So I think something that we've noticed in our business is we start to look at slightly different deals in our business now, right? We try to look, more exclusively at slightly bigger deals than what we used to. We try to look for more light, moderate value adds than the moderate heavy, really heavy
Mhm.
value adds because it
Mhm.
strains the business less.
Mhm.
Has yours shifted over the years since you guys started buying, at a little bit more of a scale in 2019, 2020 to now? We're kind of looking at the same types of deals, and how's your thinking changed about like the types of deals you want to do within the business?
I'll tell you the biggest shift, Axel, and this has just been a byproduct of competition, I think, is that we are buying more in like further tertiary markets, like further out. And that's a probably stupid strategy when you're trying to manage your own stuff. I mean, it does not, I see these guys that have a portfolio just in the northwest side of Cincinnati, and I'm like, I bet you guys are really efficient. I bet that's really nice to have so many maintenance guys so
Yeah.
close together and all that crossover. And so I know there's some operational efficiencies they have that we don't, but is it worth 30 grand more a door in your market, maybe 60 grand more a door? I don't see it. That's where I'm at. It just, I would love, we own nothing in Cincinnati. We own one outside of Cincinnati, like outside the outer in the next county over. So those people can work in Cincinnati. Kind of same thing in Dayton. Like we own on the northern side of Dayton. But then even after that, like we own in markets some people in Ohio don't know about. Certainly you wouldn't. I mean, they're not the big cities in Ohio. They're within an hour of those cities for the most part. But we bought up in the northwest corner of Ohio, which is like an hour from Toledo, which is not a awesome, it's not a target market for a lot of people. And then a lot of them, we got into Indiana. It's north of Fort Wayne, Indiana, which is a smaller market. It's not Indianapolis, so there's less competition there. I think we're buying much better deals, but two things. One, it's harder to manage for sure. And then two, you're selling in the same market that you're buying in. So, I acknowledge that. Like, I remember our very first syndication, I was pumped because we bought it at like a 10 cap. Well, we sold it at like an 8.5 cap. So that's great. But like most people at that time were selling it at 6 cap, but we were still selling in that same crappy market. So I realize that. But, since we're buying for cash flow and we would rather be long-term holders, we're fine with that. We'd rather buy at a great basis where we can cash flow really well and we'll figure out the management of it and we'll hold those. So that's been the biggest change is that I keep saying like I've been pushed further and further tertiary because I just want less competition. I think that's a great way to get good deals. And I've not been able to like source off market deals in the way you have a lot, Axel. I'm mostly getting this stuff. It's kind of maybe a pocket listing, but there's other people looking at it. But there's a lot less people looking at it when it's an hour outside of Columbus, Ohio, compared to all the people that want to buy in Columbus, Ohio.
Yeah, well, it's funny because you're describing what we do a lot in our business, right? And I always laugh talking about New Hampshire on the podcast because there's a lot of people who are not from New England that listen to this and they're like, still don't know where New Hampshire is.
Yeah.
But like, an hour north of Boston, right, is where we buy, and that's obviously, Boston being a major city, right? So it back in 2017, 18, 19, not a lot of folks doing deals up there outside of the people that were local, right? Like Manchester, New Hampshire is the big city in New Hampshire. It's an hour north of Boston. And if you bought a deal in Manchester, you're competing with like other guys and gals from Manchester.
Yep.
Over the last 5, 6 years, New Hampshire is a strong market from a fundamental standpoint, but like now it's expanded to where the guys who are doing deals within 20, 30 minutes of Boston are like, I'm not going to spend 350 a unit on a 10 unit deal when I can go spend whatever, 175, 200 a unit up over the border in New Hampshire, right? So
Yep.
the
Yep.
competition has expanded, which means
Yep.
that to buy in the more core parts of that state, it's more competitive and you're dealing with more outside buyers and more, both investment dollars, but also just number of individuals who are looking to buy there. So similar to you guys, like we've started to look at deals outside of the radius and stretching that radius. It seems like every year, right? Used to be 30 minutes, now it's 45. I'm like, we'll start to look at stuff that's an hour away, but like the numbers really got to make sense. And I'm sure that's going to continue to be the dynamic. But like what we found, and I'm sure that this is probably something that you guys have found in your business, like if you can strike a blend of willingness to do these deals in areas where other people are like, it's just too far out there. You can really secure some killer base. Like you can get them at great numbers from a pricing standpoint. You could probably create a lot of value, and you can take a lot of the invested dollars off the table in a couple of years through a refi or whatever, and start to de-risk that investment quite a bit.
Yep.
And the reason that a lot of other people don't do that is because the management isn't solved for. It's like, well, I
Yeah.
can't go buy an hour outside of,
Yeah.
Toledo, right, in Ohio, because there's like one guy who does third party management, and it's a dude and a couple of maintenance guys, and it's like a
Yeah.
pretty bootlegged operation. Whereas like if you guys are owning it, and yeah, it's a little bit more of a pain in the ass because you got to go send your regional out there to go and meet with the on-site PM, and it's a little bit more of a grind. But like having your arms around it from an in-house standpoint is like such a competitive advantage when you're looking at those podunk markets, for lack of a better way to put it.
Yeah.
That I think it's like the right. I mean, it's like, yeah, it's a great way to get ahead, right? And it's it's a little harder, but like that's really the blend is like all the guys who use third party are going to be nervous as hell to do a deal out there, which is what we found in
Yeah.
our market
And if they talk to the third party, I mean, I remember looking at those deals, and I talked to the, property management company in Cincinnati that owns 10 or manages 10,000 units. And they're like, yeah, we don't do that area. They just, and that's fine. It makes sense for their business. So then I was like, oh, well, I guess I can't look at it. So exactly your point, Axel. Now, if I'm doing it myself, well, we get to decide, yeah, we will manage that area. And the other thing I'll say is like, we try to buy 100 units at a time because we want people on site. So that's one thing that does help, where it's like, well, it's not like somebody from our home base has to be driving there all the time. Like we're going to buy enough that somebody can be there. And that's what was cool about the portfolio that we bought up in Northwest Ohio and Northeast Indiana, was it was over 400 units. And so we were getting that scale like right away. So we hired 3 property managers. I think we're at 5 maintenance techs. And so it was almost like, it's already built out that, we could hire an entire team. And then, as you know, like we're not there yet, but my vision around it, Axel, is like, you can centralize so many things that I think we can just have, we need enough out there to have the people on site. I mean, you'll never centralize maintenance techs, right? So you got to have those guys. And then maybe you have a property manager on site. I mean, that portfolio, like I said, it's a bunch of different properties. So there's only 3 property managers and there's 20 properties. So most properties doesn't have somebody on site, but you don't need somebody on site. There's so much you can do with technology today. We've got the boxes you can put on the doors for virtual, self-guided showings, or not virtual, but self-guided showings. And so like, I just think with technology and being able to centralize, I think we're going to be able to do it better and better, even with us being spread out. And the thing I'll say, like I've been kind of pitching to our investors, and just the explanation for why we're doing what we're doing is I've said, look, yes, I would love to own 400 units in Columbus versus 400 units in the middle of nowhere, Ohio and Indiana, spread all over the place. But so would everybody else. And when you buy that, it feels like I got to operate this perfectly. Like everything has to go very well. And I think we'll make decent money. Whereas the stuff we're buying, if everything doesn't go very well, I still think we got a chance to make a lot of money if we can figure out the property management stuff. So to me, it's like there's so much juice to squeeze if we can figure it out. Okay, let's go see if we can figure it out, versus there's not very much juice to squeeze, but it'll be pretty easy to man. Like I'm going for, bigger opportunity. We just got to figure out the management piece.
100%. Yeah. And as you just described, right, it's become so easy to centralize the vast majority of what occurs on a day-to-day. Because when you think about like, what do you need an on-site person for? And we just kind of went through this. So like we bought a 72 unit, the market that I'm talking about, right? An hour north of Boston. It was a $15 million deal, on-site manager when we bought it. And we inherited her, and she was doing a good job. She later put in her notice instead of the other way around. And we're like, oh shoot, we got to go find a replacement. And my partner in that deal, whose PM company manages that particular building, is like, we can go hire another 40-hour-a-week on-site person, or we can hire like a part-timer, and she can do, 2 days at another building we have, and she can do 3 days over at that one. And she's there 3 days a week. And frankly, all she's really doing is like checking on our unit turns, right? Like the showing stuff, she's doing it because she's there, but we're like very quickly realizing like she doesn't have to be there because we do all the self-showing stuff and all that. And you're signing leases online, you're having conversations with people over the phone or online. through email. You can go and look at a unit without somebody present. You can submit an application without somebody present. The only time, yeah, you really need to get involved in terms of like get there in person is like, as you said, maintenance. So it's like if you solve for that, you start to solve for a lot of the rest of it, right?
Yeah, I think
And then
so.
you're capitalizing on the inefficiency of like a very tertiary market because there's a total mismatch in terms of like the amount of buyers for something like that versus
Yes,
in a Columbus or a Cincinnati or whatever. And there you create your value, right? And I think to
I think
bring this
so.
full circle for the LPs who listen to this, and you probably tell your L, you're already telling your LPs this based on what you just said, and we do the same in our business. It's like I know that this is not a market that you maybe recognize in terms of like the name of the city or the town, but when you invest in the more efficiently traded towns, you can't capitalize on the inefficiency, which means sure you can make money, but it's going to take you longer to get to that value creation. It's going to be more competitive, and you're betting on the market much more so than this particular deal.
Mhm.
And in this
Yes,
particular deal, we can a little bit more accurately define in the short term like what we can do with it. And I
yep.
think that de-risks it a little bit for an investor, which
Oh,
I
I
think
think
is like
so for
a big
sure.
talking
Yes.
point. Yeah.
Yeah. Yeah. That cap rate. I mean, to me, if you're talking about cash flow, Axel, one thing we're talking about is positive leverage.
Yes.
Is the true cap rate higher than your interest rate? If it's not, like, it's really hard to cash flow. And so interest rates are the same, almost the same. I mean, you can get a little better rate from agency debt on, primary markets, but not that big of a difference.
Yep.
So interest rates almost the same, but if the cap rate is a full 100 basis points different, that makes a big difference in your cash flow. Again, there might not be the upside. You might do better, but like if we're just talking about cash flow, and what you're saying is true, Axel, I think like that's a little more. Nothing's guaranteed, but that's a little closer to being guaranteed than, hey, we're not cash flowing this property, but I promise you it's going to be worth a lot more in 5 years or 10 years. I'll take the cash flow as something that's more certain.
100%. All right, Lee, this has been great. I love that we got into a few different topics here, whether it's
Yeah,
capital
that's
raising,
been fun.
operations, the joys of bringing your management in house. We
Oh
probably
man,
scared a couple folks off from doing that here,
I hope
or
so.
at least, yeah, or at least
Make
really
them
gave
think
them
about it.
a full view of what's required to do so. But no, appreciate you taking the time. Where can folks learn more about you and your business?
Yeah, as we mentioned a couple times, I do like being on LinkedIn, so I'm pretty active on there. And then we do have a website. It's threefoldrei.com. That's the number three spelled out, THREE, and then FOLD, and then REI is in realestateinvesting.com. We got some free stuff there, and you can definitely communicate with me there or contact me through that. And so, yeah, jump on our website.
Love it. Thanks again, man. Appreciate it.
Yeah, I appreciate you, Axel.